Welcome to this presentation on the state of the economy and the markets presently. Global developments are substantially impacting stock market performance in emerging economies. This has been the trend for quite some time now. Last year, in calendar 2012, the stock markets in all emerging economies did very well. All the emerging stock markets posted positive returns. In India, the returns were about 25% in 2012. The primary reason for this buoyancy in the stock markets was the capital flows from abroad, particularly the capital flows from America. In the US, they started implementing the quantitative easing program after the financial crisis of 2008 and the Great Recession that followed. Quantitative easing is a program under which the US Central Bank, the Federal Reserve System, buys bonds from the market. They introduced QE1, QE2, and now they are implementing QE3, Quantitative Easing 3. Under QE3, the Fed has been buying $85 billion worth bonds every month from the market. In other words, the US Central Bank has been injecting $85 billion into the markets every month. A part of this huge liquidity went into emerging markets like India, and it was these capital inflows that led to the stock market buoyancy in emerging markets like India. In 2013, initially the year began very well, but then bad economic news impacted the markets temporarily. And in June, particularly on 19th of June, there was a major global development. The US Federal Reserve System hinted that it will start tapering the quantitative easing program. Tapering means slowly reducing the bond buying program and ending it by sometime in 2014. This announcement sent shockwaves through emerging markets, and this led to huge sell-off in the emerging market bonds and equities. This capital outflows from emerging markets to America depreciated emerging market currencies, particularly the currencies of countries which have high current account deficit were seriously impacted. Presently, there are 5 major economies in the world with major current account deficit problems. These 5 economies are India, Indonesia, Brazil, South Africa, and Turkey. These 5 are known as the fragile 5. They are very much prone to capital outflows. So emerging market currencies, particularly the currencies of the fragile 5, were seriously impacted. Indian rupee touched an all-time low of 68 rupees 85 paise to the dollar on 28th August, and stock markets reeled under selling by FIIs and also the mutual funds. But then the scenario completely changed. On September 18th, the Fed took the markets by surprise by announcing that they are postponing the tapering program. The US economic recovery has not been as strong as expected, and therefore they said the tapering program initially visualized will be postponed. So that again led to the reversal of capital flows. Again, capital started flowing from America and the developed markets to emerging markets. And this again in September, the second half of September and early October, strengthened emerging market currencies, and the stock market started looking up. So we have to appreciate this very important fact. Investors should be aware of this very important fact that the markets are hugely influenced, even dictated by capital flows from abroad, capital inflows and capital outflows. This is a very important feature of the times in which we live. But globally there are some positive developments. And the most important positive development is the American economy coming back to growth, even though the growth is not very robust. There is growth. US is likely to post a GDP growth of more than 2% this year. There is a stability in markets. Housing markets are looking up. Employment figures are assuring. And Europe, the surprising part is Europe is coming out of recession. The pigs, Portugal, Ireland, Italy, Greece and Spain, continue to be in trouble, but then the worst part of the troubles are behind them. So Europe is not likely to throw up very bad news. There is good news coming from Europe. Japan is on growth path. That is a major fillip to the global economy. And China, after dipping to 7.5% GDP growth, is once again showing signs of moving to a higher growth trajectory. This is the global economic background. Coming to the Indian economy, the macro environment continues to be weak. GDP growth last year in 2012-13 was at 5%. This is a decade low. And in the first quarter of this year, GDP growth is only 4.4%. IIP figures are not reassuring at all. There are no green shoots of recovery. Of course, one can assume that the growth has bottomed out. There are indications of growth getting bottomed out. But the green shoots of economic growth are not yet visible. Inflation continues to be a problem area. Even though core inflation and manufacturing inflation are at low levels, CPI inflation is very high, consumer price inflation is very high. Food inflation is going up unabated. So this bad news on the inflation front means that the RBI will not have any room for stimulating the economy through interest rate cuts. It would be very unrealistic to expect the RBI to cut the repo rates in the coming days, even though they can think about reduction in the marginal standing facility. On the fiscal front, the finance minister has set a very ambitious fiscal deficit target this year at 4.8%. This means, in the background of the very low economic growth that we are having presently, the government will be forced to cut planning expenditure. So that means a fiscal stimulus to revive the economy through increased planned expenditure would also be difficult. In brief, a monetary stimulus by cutting the interest rate and a fiscal stimulus by increasing public expenditure, both these are very difficult under the present circumstances, and these are not good news from the macroeconomic perspective. But certainly there are some other good news from the macro perspective. And the most important of that is that the current account deficit, which was India's major structural problem, the current account deficit is coming under control. The current account deficit, which was more than $80 billion last year, 4.8% of the GDP, this year is likely to be less than $60 billion. Government's initiatives in curbing gold imports and also in attracting more capital inflows into the economy by liberalizing the FCNRB account scheme, all this has yielded good results. So this year the current account deficit is likely to be less than $60 billion. So it will be very much under control. And because of the capital inflows which the economy is getting right now, the rupee has strengthened. It has strengthened to around the 61-62 level. It is stabilized between 61-62 levels from the low of 68.85 touched on the 28th of August. So stability in the exchange rate, a steady decline in the current account deficit. These are very welcome developments from the macro perspective. As far as the results are concerned, these are, as I speak, these are early days, but the initial results, corporate results, Q2 results, have proved to be better than expected. Private sector banking has posted better than expected results. IT has come out with spectacular results. But then these are early days. It is very difficult to take a call on the Q2 results at this juncture. In the second half of this year, economic news is likely to improve. There are two primary reasons for that. One, we had bountiful monsoons last year, and therefore this year, not last year, this year, and therefore we are likely to get a bumper harvest. Agriculture growth rate is likely to be around 5%. It is very important to understand the fact that 5% increase in agricultural production means 15 to 20% in agricultural incomes. Since 50% of Indian labor force is even now employed in the agricultural sector, this 15 to 20% agricultural income growth can produce very good, positive, favorable multiplier effects on the economy. This is the reason why rural consumption, even during these very bad times, continues to be very, very robust. Apart from this, the coming days are likely to witness increased spending. Elections in India means increased spending. There will be a lot of spending in the economy by political parties. The money that is being injected into the economy, that will have its own multiplier effects. Therefore, H2, second half of 2013-14 is likely to be much better than the first half, and we can certainly clock around 5% GDP growth for this financial year. Coming to investment strategy going forward, investors should understand the fact that at around 21,000 levels, the markets are not cheap. As I speak, the market is only 100 points away. The Sensex is only 100 points away from an all-time high. So valuations are not very cheap. Valuations are not very attractive. I won't say that the market is fully priced. There is still room at the top. particularly when you have liquidity flows, price earning multiples and valuations become secondary. So there is room at the top, but investors will always be appreciative of the fact that in performing sectors like FMCG, IT and pharma, valuations are very rich. In IT, of course, there is more room for the stocks to go up, but for FMCG and pharma, the valuations are very rich. From the investment strategy perspective, we would advise investors with a medium to long-term time horizon to remain invested in these performing stocks, in these performing sectors, FMCG, IT and pharma. Remain invested in this. In IT, investors can think of further buying on market dips, because the medium to long-term prospects of this industry are extremely bright. So dips in the market may be used to buy IT stocks. From the longer perspective, medium to long-term investment perspective, investors should now start looking at sectors which are languishing and stocks which have been beaten down. Many of the stocks which used to fly previously are now down 60%, 50%, 70%. Sectors like infrastructure, capital goods, because of the slowdown in these segments, in these industries, are available at attractive valuations, particularly mid-cap stocks. Some of the large caps, blue chips, are priced, but then mid-caps are not priced. So there are stocks in growth industries, industries which will continue to grow irrespective of the economic performance. So mid-cap stocks available at attractive valuations in the beaten down themes, in cyclicals, good quality management companies, in beaten down sectors or sectors undergoing cyclical downswings should be selected for investment, because the cyclical downswing is, as the name implies, only a cyclical downswing. An upswing will come, and when the upswing comes, these stocks will perform. Already we can see a lot of activity in mid-cap stocks. Investors with a long-term horizon have slowly started accumulating these stocks. A major development that will impact the market going forward, I'm talking about the Indian market, not all emerging markets. It is important to understand this fact that emerging markets will be influenced by capital flows. But in India particularly, the market will be hugely influenced in the coming weeks and months by political developments, particularly news and trends relating to the next year's elections. That will have a huge impact as far as the market is concerned. The market is likely to discount the outcome of the elections much earlier than the actual event, because the trends will be available from polls before that. If India gets a government headed by either of the two large parties in the next elections, that will be good news for the markets. But a government headed by a group of parties which are not either of the two large parties, with one of them supporting the government from outside, to be blunt, a third front government, will not be good news for the market. This is a very important point that investors should be looking for. So watch out for the political development and trends. Presently the markets are going through buoyant times. We are approaching an all-time high. Perhaps by the time you watch this video, the markets would have already reached an all-time high. It is important to understand that there is a disconnect now between stock market performance and economic performance. But the disconnect can continue, the market buoyancy can continue because the capital flow environment is very favorable. Watch out for the developments, particularly watch out for developments on the political front. Best wishes.
Now you can play your music as loud as you want.
There's always a simple way to do things. Trade online at Geojit BNP Paribas. It's fast, easy and secure.